Welcome to TheoTrade. This is Don Kaufman. Here we are. It's October 9th, 2017, doing the Theo Night video. There is just about 7 minutes to go to the cash close on this light trading Monday. Now, for those of you unaware, it happens to be Columbus Day. Because it's Columbus Day, it's considered a bank holiday. The treasury markets are effectively closed. Now, yeah, the bond futures, the electronic market happens to be open, but overall treasury markets are closed, which is going to give us substantially less volume even in the S&P futures. As you'll see, again, just a few minutes to go to the close, we're only doing about 625,000 contracts, and where the S&Ps slipping ever so slightly to the downside, the Nasdaq futures. I'll tell you what, the Nasdaq futures have had a bit more of a range today, but do appear close to massively unchanged on the trading day. If you take a look at the Russell, now the Russell is an area that I want to key into here for a moment. I've been talking extensively about the Russell lately for the most part. Why? Well, I mean, it hasn't had much of a downtick since now we're looking at mid-August. Now, granted, here we are, we're coming towards mid-October. This is a product, the Russell, that has not had but really one or two downticks literally since mid-August. Well, today will be one of those downticks. The Russell is off today by almost 0.5%. All right, so does that mean broader weakness in the market? Not necessarily so. Again, we're still seeing strength inside of the Nasdaq, specifically coming from like Apple, okay? Google had a run to the upside today, hit 1,000, reversed off of 1,000. I mean, Google literally hit 1,000 on the button, and this is Google L. Hit 1,000 on the button, it's been drifting lower after that. Amazon right back into the 1,000 kind of marker earlier today. Nevertheless, I'm going to take you in direction today that if you're thinking, it's kind of a light trading day, there's nothing going on, not necessarily so. Two areas that I really want to key into. Yeah, we showed you a little bit about the Russell. The financials today are also backing off just a bit. When I say really an area I want to key into, we're going to take a look at what's called the VVIX. Now, if you are unfamiliar with the VVIX, okay, first of all, what am I even looking at? This is not a tradable product. All the VVIX is, okay, it's the volatility of the VIX. So a lot of people look at the VIX, and we'll pull up the VIX here momentarily, and the VIX has not exactly been awe-inspiring lately, right? It's been, what, 9, 10? And if you look at the VIX, okay, in some recent trade, my gosh, the VIX is actually picking up to the upside here ever so slightly. But again, we're moved from what? Here we are at 9 and just to 10. It's, again, not exactly spellbinding kind of move in the VIX. Nevertheless, the VVIX is seeing some action right now, and it definitely warrants discussion. So last Friday, okay, and this is literally Friday, and here's Monday. And again, I'll kind of elaborate upon this for a moment. This was Friday's trade. This is ultimately today's trade. Last Friday, we saw the VVIX spike. And again, it's the volatility of the volatility index. What does that mean? Okay, for the most part, the VVIX moves when there's heavy, okay, bid in options activity, specifically in the VIX options. Now, the VIX is a highly convoluted product. Okay, for the VVIX to go up, it's, again, everything's supply and demand in options. Like, people get into it's Black-Scholes, it's the Cox-Rubinstein model, forget all that stuff. In the end, options are supply and demand. And right now, there seems to be a fairly substantial demand for volatility. That is, traders are coming in and they're buying volatility. How do I know they're buying volatility? Well, that's the only way to get the volatility of the volatility index to increase. But here, now we're starting to get into statistical significance. We're looking at, 10, 12% moves on the volatility of the volatility index, which means, for the most part, if you look at the move today, again, the VVIX today, it's up about 5%. Well, it was already up, 6% on Friday. Again, on Friday, we assumed that the VVIX was higher because there was a little bit of geopolitical risk. Like North Korea was discussing fueling a missile on Friday afternoon before the close, and we assumed that's why the VVIX got bid up. But that geopolitical risk kind of fizzled out this weekend. Here we are on Monday, and again, it's kind of a holiday trading session today, and yet we still see a bid underneath the volatility. In fact, when you start looking at this even on a 1 minute, okay, here happens to be some of the trade from Friday, and continuing again today, and late in the trading day, we're seeing a bid again to the VVIX. Now, people are going to, again, does that mean that we're going to tank in the marketplace? No, not necessarily so. That's not exactly the way it works, okay? There could be infinite numbers of reasons that traders would come in here and buy volatility. Now, first of all, when they're buying volatility, they're buying calls, right? Because what happens if the market does go down, okay, the VIX inherently goes up, right? Market goes down, the VIX goes up. So to profit on the VIX from an increase of the VIX, they go out and they start trading calls heavily. And you can see, obviously, the number of calls that are trading is pretty phenomenal, but this is nothing unusual. In fact, if anything, this is well off the normal pace, okay, of action inside of the VIX. Nevertheless, again, we're still getting some heavy bids for volatility in here. Now, the reason I say it doesn't necessarily mean the market's going to tank, there's one of two ways you can look at this. You can say someone's buying volatility because they think the market's going to tank, or you can say somebody's buying volatility because they're afraid the market could tank. It can be a hedge or it can be speculation. And you will never know. You just can't know whether, which side of the coin they're on. Nevertheless, there's a few trades, and you can see I've been trading and kind of hammering away at the VIX product a little bit. But there's a few trades that I think you can pull off quite effectively inside of the VIX right now. However, some of this is a little bit up the learning curve, okay? I'm going to be talking about it a bit tomorrow morning on TheoTrade chat. When I say it's a bit, up the learning curve, one of the advantages, there's the closing bell, one of the advantages that the VIX provides is that there's this enormous skew. And what that ultimately means is if you look at the option that I'm circling right here, this thing's effectively got right around a 96% implied volatility. That's kind of what's pricing these options. You start going further out of the money, you got options here that are pricing off of 150% implied volatility, okay? So you can kind of do types of ratio spreads in here, okay? And again, this is the part you may or may not like and you may or may not have margin for, but I'll give you an example. You can turn around and, for example, buy, okay, maybe one of these little monkeys, right? So you buy one of these. What are these? The 13s. And you can turn around maybe and sell 2 times as many out of the money options. And if you start pricing this thing out, okay, it's not half bad because, again, the skew is favorable. But if you buy one and sell 2, you are left naked on one contract. Now, that not only is scary, but it should be scary. What happens if you went out there and you bought one of these, 13s, right? So let's say you bought one of these 13 calls and you turn around and you sold, for example, 2 of the 18 calls. The entire trade is done for what? It's almost even money. It's a 5-cent debit, but you're buying 1 and selling 2. But if the VIX turns around, okay, and spikes, okay, let's say the VIX spikes up. Where can the VIX go to? Well, let's say the VIX gets all the way to, for instance, 25. You're short 2 of the 18 calls. So you're actually going to get caught naked, okay, on one of them. You're going to be naked short on one of them. And again, you can see the price of the trade is basically 0. So this trade is done for even money. So you can make money from 13 on up to 15. 13 on up to 18, but you start getting above 18 and you'll start losing some money on the trade. But you're like, I don't like it. I don't like it at all. Okay, I get you might not like it, but I've already got a few short positions in the marketplace. So if the VIX is spiking, my short positions are already profiting. Okay, so for the VIX even to spike to 30, wouldn't really be much skin off my back. You just have to be comfortable with being naked short a contract in here. And you can further that, like I'll turn around and I'll sell a few of these 11 puts as well, okay? And just, you know, add a little bit more of a credit. So I'm doing the entire net spread for about a 40-cent credit. There has been a lot of discussion of this type of a trade. There's a trader that's been coming in lately, okay, and doing a very, very similar position. And they've been doing it hundreds of thousands of times, okay? So we've looked at this trade extensively. Now, again, they've been doing it in a variety of different expirations. You can see I've got one on in November, okay? You can cruise out to like December if you want to see the big position here. Trader's been basically doing this. They've been turning around. They've been selling these 12 puts, okay? So this trader's been selling the 12 puts. They've been then turning around, buying the 15 calls, okay? Then they're going way out of the money. An example, selling, okay, 2 of the 25 calls. The entire trade is actually done, in fact, for a 65-cent credit. This is not too different from what I am actually propositioning. And the skew has actually gotten even more favorable than when this initial trade was put on. When this, you know, initial trader came out, they literally did the trade 500,000 times. Okay, the skew was not nearly as favorable as it currently happens to be. Now, yeah, you could do it 71 days out. For me right now, I'm actually doing it in the slightly shorter term. I'm actually hopping into the November options, which are going to give me a lot more, again, the November options that are 36 days out, they're going to give me a lot more bang for my buck, but I did not sell. Okay, the out of the money's nearly as far out. I'm using actually these 18s. If volatility does spike on me, so be it. I've already got some short S&P positions ultimately to cover my risk. Now I know that the learning curve for some of this kind of gets a little bit steep. A few of you guys listening to kind of, you know, this is the nightly video over here. If I threw it for a loop, that's fine. Hop in our chat room, check it out. We have hours and hours of sessions regarding how to use products like the VIX most effectively. Thanks everybody for joining us at TheoTrade. Have a wonderful evening. Bye-bye.